Susan's still live, huh?
We're doing it live, Ryan.
Huh? Guess Susan's on with us this time, huh? Oh,
Maybe. I don't think, does that even hide it?
Welcome, everyone, to Name Confidential Live.
that sounded fast. Hey, welcome everybody to Name Confidential. I'm this week's host, Ryan Redfern. I'm in for Kenton, who couldn't make it today. Today we have Branden DuCharme, CMT. This is going to be a CMT chart nerd fest, so I can't wait. Branden from DuCharme Wealth Management. We'll talk a little bit about him in a little bit and talk about charts, what we're invested in, what's going on. But I wanted to start with the name sentiment, name exposure index. Grab that here. And Branden, you are a contributor to this, I believe.
Yes.
You are. We're 81.58. What did you report this week?
In my equity allocation, I'm 100% exposed. So I'm not neither levered nor chips off the table.
Nice, nice. I think I
So
reduced.
just
I
standard
was
allocation.
no, I got it. I was 90% this week. So two of us, we're bringing this number up. I want to know who's selling off or who's on defense already. It's not quite time yet.
Yeah, I think one of the I think it was Tom McClellan put something up actually about a divergence that he noticed in the index, and he
Yeah.
said that that tends to be an early indicator that he felt name members or active managers had done a fairly decent job historically at lowering exposure, but generally speaking, too early, right?
Yep.
Which I think we could have a conversation about market structure and kind of the effect that passive flows are having on the market that cause these tops to form after the divergences in momentum, I think, really form. And so active managers are largely getting out sort of just too soon, maybe
Yeah.
it was the call. And that's a little bit refreshing because obviously the call is normally, hey, it's the world's greatest contrarian index.
Right.
To which point, at 81, it's okay. So do you want to be bullish or bearish here if active managers are kind of just near historical average? How do you contrarian that? I don't know. But it's hard to, what I'll say is for the people that aren't heavily invested right now, it resonates with me. I think from a fundamental basis, if you look at more of the macro picture, the economic data, it's concerning. I think if you look at valuation, it's sort of concerning. Um, it seems to be a lot of irrationality. If you're somebody that talks to people, I mean, I'm out on Main Street a lot, so to speak, right? I talk to a lot of really regular people. I deal with mass affluent and high net worth people just in my community primarily, right? And you talk around to business owners and people in the community, and it's tough. It's not what it was. If you look at real estate data and residential real estate data, a bit concerning in a lot of places.
Very much so.
Yet the market is still just grinding higher, and so I from a fundamental standpoint, it resonates with me. I'm not saying that I'm out. In fact, I'm in, but I at least can understand why. I think they've got the call wrong,
Yeah.
but you can at least get it, and that's up for them to manage and the individual mandates of their own investors and seeking that best interest. But I we both know there's people that probably reported plus 200 this week too. So
Yeah. we know exactly who those people are.
and well, and so now the number is real, what I mean? There's really people that have got to be really low exposure, right?
Mhm.
Um, but by and large, I think what you have to look at is in that index, it's really that you got to pay attention to that historical average, right? And so last quarter, the average was 73, but I think the historical average is closer to 80.
Mhm.
Um,
Yeah.
and so, they have more exposure on than they did last quarter, and they're just near historical average. So, is 100 really does that mean allocators are 100% long? I think you really have to weigh it out. How does everyone report that number? And everyone kind of comes to that a different way, right? So for me, I report that number based on the allocation that I have to beta in the in the appropriate beta sleeve, right? Of a given portfolio that I track, right? So, but somebody else that might be managing a 60/40 might report when they're fully invested in a 60/40, they might report it as 60%, right?
Those exist.
So
those do actually exist in this
yeah,
model.
yeah, you're right. So like 81 really could be the standard 100 if that's, basically the historical average. So 81 could mean en masse, actually allocators are slightly more exposed than standard, right? I think you have to sort of read it that way. But to your point, yeah, who is out? I don't know. I probably could know. If I thought hard enough about it, we probably could, everyone seems to have their personalities about things, but
Yes, they do.
by far and large, look, it's a compelling market when you have, what's the, you've got, here's just an interesting perspective to think about on it. Let me pull something up here really quick.
Yeah.
So people talk about unemployment, right? And they say, man, unemployment goes from 3 to 5. That's really going to be, that's crazy, right? That can get crazy. And that's true. But what that still translates to is, this is the part people forget, 95% employment, right? Like if 5% are unemployed, 95% still have jobs.
Yeah.
Well, if we look the last couple months at flows, you've got, and I'm referencing just some data provided from Tier 1, my friends over at Tier 1 Alpha.
Okay.
So January of this year, $64 billion of flows into 401ks. And that's pretty standard all the way. It's 64 billion and change basically every single month through here. So even if you had 5% unemployment or 7.5% unemployment, that still equates to 92.5% employed. And, even if you say, okay, well, things tighten up, so let's kind of increase the number to the flows getting tightened off 10%. You're still talking about like $55 to $58 billion a month that needs to get bought.
Yep.
And
largely flows into indexes like the S&P or these target date funds, mostly.
Yeah. It's so it's hard to be under allocated right now in the current market is my thought. It's now if you haven't been involved in this rally, I'd really caution people. My general idea is don't get over allocated, right? Be cautious being greedy, right? That's always a good portfolio management idea, right? Don't let that take over. But this idea around systematic flows and the relationship between that and the Fed's appetite to run, loose monetary policy, Congress with really loose fiscal policy, wanting to do that. I think there is an idea out there that I'm a fan of this debasement trade. And, the best way to be allocated through that trade is to just be allocated to something other than US dollars. Right. I would say, careful if you're wanting to price your assets in foreign currencies. That might come with more of a drag than people care for over time. Certainly there can be trends there to catch a ton of return, but right. I think the general theme is, I don't want to own dollars. I want to own assets.
Do you own things like gold right now?
I own what textbooks would look at as a disgusting amount of gold, probably. I think if I had to report to the CFP board, which I'm not a CFP.
Sure.
If I had to report to them, like how much gold I find prudent to have in people's portfolio, they would be like, they'd probably, kick me out of the room. I don't know, but I just look, the reason I own gold is like, so I got interested in gold actually, not really through the deflationary trade originally, or not deflationary, excuse me, the debasement trade idea, right? What originally piqued my interest in gold was just this non-correlation to stocks and bonds, and it just being a diversifier in portfolios that seems to have a positive return over time, right? Like to me, that's all it was. It started out really as like a hedge. And the more that I paid attention to gold, I learned some new things, right? And here's the thing that I learned about gold, what changed it for me, where I said, okay, I really like this idea of gold and I like it for a longer term idea rather than a short term hedge is, and in a greater size than I originally maybe owned it, is when you start pricing things in gold. So if you go,
yes,
you go and price stuff in gold, it will change your life, right? Like that's the red pill. If you, if you're looking for one, go take like, and you can do it for just about, I have yet to find something that like it doesn't really work for, right? And so simply all you do is go find the first time I ever did this. I actually had, I used to work in geomatics. And we sold survey equipment to land surveyors and civil engineers and stuff. And I had a quote that we had run in 2019 for a firm, and I called up my buddy that was still in the industry, and I said, "Hey, send me this quote. Resend me, like requote me the same thing that we quoted back in 2019. Just quote it in today. Like, what's the price of that same thing today in today's dollars?" And I dropped it in, and then I took the price of gold in 2019 at the time, and how many ounces of gold would it have taken to buy that unit in 2019? And yes, the price of that unit has gone up with inflation. It is significantly more expensive today than it was in 2019. And this is like a $40,000-ish piece of equipment we're talking about. So it's not like a small, you know what I mean? So we're not measuring a bag of chips here. And then you just measure it in ounces today, and you're like, okay, well, the price has gone up. It was like 25% or 23% or something. But if you measure it in ounces of gold, it was half the price. It was half as many ounces of gold to buy.
Oh, wow.
Significant, like really significant.
Yeah.
And so that opened my eyes to start doing this some more and more. And so now the simple one that I like just use to people to explain that resonates with a lot of people is, and here's what drives that, right? Is technology is deflationary, right? Like most people would agree with that. That's a whole kind of idea of technology, right? You use technology to be more efficient. Efficiency, can lead to deflation, right?
Okay.
So when's the last time you bought a 55-inch TV, Ryan? Or you know what I mean? When's the last time you bought a flat screen TV?
Right.
Like seriously, when? A couple years ago? Recently?
Probably
a couple years ago.
Yeah.
So I bought some. So in 2023, I bought like 5 of them for my office here. Is like the last time that I needed to. Dude, they were $200 a piece for 55-inch flat screen TVs, $200 a piece down at Costco. Yeah. Right. And okay, what would a 55-inch TV screen costed when I was back in high school? Or, you know what I mean? If you think back to 2010, what did a 55-inch flat screen TV with $1,500 TV?
Yeah, maybe 2000 depending. Yeah. Yeah.
So you're like what do we take? 75, 80, 90% cheaper potentially today than they were, 15 years ago. That is totally how do you argue that that's not deflationary, right? And so the idea is if you go and price that in gold, you're saying the purchasing power it requires in terms of ounces of gold today to buy that TV. And then I'm going to preserve that purchasing power. Okay. The debasement. But then when I really get the return out of gold is when I allow for technology to still give me the deflationary pressures in the economy. So I'm thus I'm not just inflation, right? So it's not just an inflation hedge, but it's preserving that purchasing power to then go rebuy the good you're wanting, not rebuy, but buy the good you're wanting to buy in the future after technology has brought down the price, right? So if TVs are deflationary, the economy as a whole is inflationary, but the things you're wanting to actually purchase are deflationary because of technology. It's a really interesting idea that maybe I sound like a total nut job to most people. I don't know, but it makes sense to me, right? I get to take advantage of kind of both things with something like gold. And I think that largely applies to a lot of stuff that's just hard assets, right?
Nice. Nice.
So, I
So
mean,
do you have a target for it, or are you just gonna let it ride for a bit? What would make you change your mind on the gold trade?
you know, uh, uh, I'll put it this way. When we were at the conference in May, and there was a member, and he knows who he is, and said gold is more than three standard deviations above its historical, returns.
Yep,
You
I know
got
what
to
you're
think
talking
about
about.
selling your gold, guys. You got to think about selling your gold. And I sat there going like, I don't, yeah, I mean, he's got a point,
Hmm.
but I'm not sure. And gold has gone through a very actually tough sideways period since
Yes. Yep.
until like this week. You know what I
Yeah.
mean? Like it
Yep.
has not been an easy ride. You've had no positive real return since you even said that back in May.
Right.
Um, and I love the guy, so I'm not going to put his name out here. He's a great guy. Um,
Yep.
but I just looked at it and I go, I don't know that I want to sell that, especially, again, if you're owning it as a diversifier in a portfolio and
Sure.
equities are on the tear, why sell your diversification?
Yeah.
You hold on to it. And uh, I think there's opportunities to tactically trade gold a little bit here and there, but I think it's tough. It's like trading interest rates. It's a little bit more
Yeah.
macro driven on the
Sure.
shorter term trades. But uh, yeah, I don't know. I I think if it gets too parabolic too fast, you can trim.
Yep.
I think one of the things that people have to remember if they're going to try to trade gold or trade commodities in general especially if you're somebody that's a technical trader like you or I,
Mhm.
is equities, right? If we see really strong momentum in equities, that's like it tends to be a great signal. Like,
Yeah.
okay, stuff can stay overbought for a very long time.
Yep. Yes, it can.
In commodities, that's not the case. That's usually the good indication of time to trim,
Sure.
So, um, you just, uh, I think there's a segment of my gold exposure I'm willing to trade, and there's a segment of my gold exposure that I just want to probably own in portfolios, and those are two
Yep.
different sleeves, if you will.
No, that's
But
fair. Yeah.
certainly, if asteroids of gold start falling out of space, I'm gonna pair my exposure. I'll
Yes.
sell.
Right.
But
Could be quick. Yeah.
I think an interesting idea is like around the gold miners still. Um,
Okay.
just say like they're not very levered because they got beat down so bad in the past. And I would say when those finally, and they've been good this year,
Mhm.
but when those go
Yeah.
on an absolutely hyperbolic tear that you see sort of retails in, it's being talked about everywhere. The money flow index is way
Mhm.
overbought,
Yeah.
then yeah, that might be a good indication, right? Like
Mhm.
once people are to the idea of like, hey, gold is not even a good enough return. We need to get every leveraged exposure out of this as well, and it becomes super crowded. I mean, that's with any commodity trading, right? When when there's no one left to buy, it's a great time to sell.
Absolutely.
Um, but
Commodities are tough.
easier said than done. Easier said than
It
done.
is. Commodities and gold, they're tough to trade. They're absolutely tough to trade. And I've spent a lot of time over the years, and now it's been easy because it's just going straight up. So there's a lot of people who think they're good at trading gold, and when that stops, it's going to be a whole different
I,
world.
I I haven't done a lot of trading gold this year.
Mhm.
I would say I've done more at strategically trimming off a position when it's overweight already,
Sure.
and gold's, seems to be overextended, and add when I think it's in the uptrend and on a good dip, and you can, again, just so I would say more strategic rebalances truthfully than
Sure. Sure.
trading. Um, but it's, yeah, and if you think gold is hard, I mean, silver is like
Oh, absolutely.
that's,
Absolutely. Yeah.
that's
They're both they just do whatever. There's no trend. There's really not trending to
but
them. You can
but like isn't that what makes them great in my opinion, right? Like that's what makes them diversifiers.
I like easy trades, and those are not it for me. I'm lazy. I
Yeah, but
want the easiest trade I can get.
you can, but if you put them in a portfolio and you're trading the equity side of the portfolio, and you can just
Yeah.
own some other stuff as diversifiers that you
Yeah.
don't have to try and trade, then that's an interesting idea, I suppose.
Yeah. Yeah.
I
That's
mean,
fair.
we all love easy trades, Ryan.
I know. I know. I just live for those things. So yeah. And
Hey,
and funny, go ahead.
no, go ahead. What,
Funny
funny
side
what?
note, I sold our gold this week. I made what I wanted out of it. I was real happy about, very good numbers on it. I'm happy to close it out. I was leveraged 2x gold that I owned. Uh,
Oh,
so
yeah. You don't mind
I
the
was like,
K1s, huh?
yes, we talked about that. And I was like, oh, I've got to close this for a good number that I'm happy with, so I can, when I have to show this to clients and at the end of the year when they have to do K1s, like, at least we made you good money on it. And we did. So I'm happy about that. But I had to call it quits. I had to call that good. So
Yeah, I mean, it was a good, it was a good run. I think it
yeah,
still has room to go.
it could.
But I, I don't know that it just goes up in a straight line.
No, no, no.
Gold's kind of a base and breakout thing, and
Yeah.
you really kind of never know when the base is going to break out.
Yeah. No,
It
and
could
this
be
thing
a long time.
it'd been grinding sideways on me forever. And I was buying on the dips. I like every time like I'm gonna add a little bit, gonna add a little bit. And it
I
was it
think if
was
you look at the
great.
chart, there were some good opportunities to buy the
Yeah.
dips. I think
Oh,
if you kind of
absolutely.
watch momentum and
Yep.
stuff. Um, but I'd really like to see Bitcoin rally again. I'm
Yeah, it's
just
struggling.
that's
It's
a
down today.
really
Yeah.
that's another one. Like it can be a real terror to try and trade Bitcoin.
Yeah.
Like it can
Yeah.
really, it can bite you. Um, and I'm looking at it and it looked kind of looked cup and handily, and then it kind of broke out, and then all of a sudden it's like, well, let's revisit that handle, and all of a sudden you're like, yeah, that's
Yeah.
not
Yeah.
the technical pattern you want to see.
Right. Right.
I mean, it definitely feels like we slowed momentum, kind of coming into some really good, significant support.
Mhm.
But it's always more fun when it's on the tear from the towards the upper right.
Yeah.
And I think we've got some sideways. We've got some chop to deal with in Bitcoin. But what's interesting is the volatility is really compressing,
Mhm. Yeah, it has been.
and that's something to shout out. Old Steve Straza over at All Star
Yep.
Charts. That's like kind of
Uh,
one of his things is you watch stuff that is volatile become not volatile, right? And that volatility just compress, those Bollinger Bands tighten up. And when that happens and you're in an area of support, it usually turns into, all it takes is a little bit of catalyst to kind of release the spring to the upside on that stuff, right?
yeah. Oh, for sure. For
Now
sure.
it can release it to the downside always, right?
Yes, it can.
but, yeah, the trick is finding out which way it's going to go.
Yep. Yep.
Um,
For sure. Well, apart from trading these things, we were talking earlier about systematic versus discretionary, and I think you and I both kind of lean towards discretionary as much as we try to build systems that are fully, automatic. You just something about it, you have to step in and add your own thing to it. I've had a lot of trouble myself. I'm kind of curious if you want to give any insights to that.
yeah. So I think what I've found works for me is staying systematic on the equities exposure. And the way that I kind of tend to, not always, but tend to manage portfolios for clients is, systematic equity exposure. So just, data driven. And then I run a liquid alternatives overlay on it.
Okay.
And that's where I use more discretion versus,
Sure.
Quant data
Mhm.
or signals. So I'm using the technical toolbox on the liquid alternatives, but where, yeah, it becomes a different animal, right? That's less, systematizable, and you just have to feel comfortable with that, right? Like, I mean, like you said, everyone's got their own flavor, and if you find you can do full discretion. I mean, I do run one full discretionary strategy, and um, it's it does fine, but
Mhm.
it's a different, it's a different animal. So candidly on that strategy, which is not it's a strategy I run my own my own Roth money in, actually. I'm actually slightly underweight on equities right now. I've pared back my exposure. As we've kind of come into these negative momentum divergences in the S&P. We're now at a point where if things kind of go sideways, there's people are in the market, which means there's people that can sell, right?
Mhm.
People can't sell what they don't own, so to speak, right?
Right.
um, but even at that, I'm still actually probably quite leveraged because I still own a significant amount of what is typically found in my liquid alternatives overlay. So I'm in Bitcoin and gold and the miners, silver miners, gold
Yep.
miners, uranium mines, rare earth metals, which has been a great trade.
Yeah.
Um, I've got interest rates in there at the moment, which has been just like the first for me in years where I've had a place. So I picked up a leverage position in kind of the belly of the intermediate, midterm treasuries.
Okay.
Um,
There have been
and
trades in there in the past few months. It's not much. I'm still not a buy and holder, but there's definitely been trades in that
yeah, so, I mean, if I pull it up, I use, Simplify has a leveraged, treasury fund, TYA is the ticker,
Okay.
risk parity treasury ETF. Do your own research. It's more or less a
Yeah.
lower yield and more duration, to give you the leverage exposure on kind of a 10-year treasury.
Okay.
So it gives you a little bit advantage over having to do like a daily rebalance on something, like with a swap or something under the hood.
Sure.
Let's see. I mean, I first put that trade on the 21st of July,
Oh, wow.
and I actually increased size on the 12th, and I increased size last time I bought was on the 26th. And I'm probably getting close, truthfully, though, to exiting that position, But it's interesting looking at the 10-year yields. I mean, I thought we were kind of in this wedge, and
Mhm.
it really broke down this week. The
Mhm.
last 3 days. I mean, it kind of had. I was like, it had. What was that like? End of last week. I'm like, okay, broke down below my support line, and then what was that on Tuesday this week? Yields pop back up, and I'm like, okay,
Yeah.
there was the shakeout.
Right.
I'm like,
Right.
all right, cool. We're still in the wedge, and then all of a sudden, yeah, what is that? Wednesday, Thursday, yeah, Wednesday, it broke down, and I'm
Mhm.
like, okay, and then yesterday, I'm like, we're right in this really interesting support area on, right at 4.2 on the 10-year, and now today, I'm like, that just came off a cliff, man, and busted right down below what I thought was some pretty major support
Right.
rates. And so, I tend to see that stuff. And when rates get oversold, that's like when you want to sell your bonds. So
Right.
it's
Right.
like,
Yeah.
but I'm trading. I'm not trading. The way that I view that in this particular portfolio I'm talking about is I'm not trading. I'm not trading bonds. I'm really not interested in the carry. I'm trading duration risk, right?
Sure.
I'm trading duration risk
Right.
pretty, and interest rates. So
Yeah. Well, somewhat related, the Fed is very, very likely to cut rates in what, a week, 2 weeks from last Wednesday? I think it was 17th. It's like 95% probability last I saw.
how
So,
magical is it going to be for the markets if they somehow don't?
geez.
Whew.
I'm not sure that's actually a scenario, but it's possible. Anything's
I don't think
possible.
so either, but my people are so committed to it that it's almost,
Yep.
it's interesting. The markets can get so committed that it's almost self-fulfilling. Uh,
Absolutely. Absolutely.
so who drives the Fed? I don't, is it Jay Powell? Is it Trump, or is it just the bond market? I don't,
It
I don't
should be
know.
the 2 year, as McClellan says, Tom McClellan. I love his chart on that, but yeah.
Yeah, he's been saying it for 2 years too.
He's been saying it for like
He's
15
been
years. It's been right. It's a great
no,
chart if you've not seen it.
well, no, I mean just like the last 2 years, he's been like, you
Oh,
need to cut now. The two
yeah.
years, 2 years
He's
down, you
been
got to
right.
cut now.
Yeah.
Um, yeah, but to give, if we're giving credit today to like friends of name, then I think Jim Bianco's got a really interesting
Yes.
perspective. Like that COVID fundamentally changed the economy.
Yep.
We're just in a different cycle. And so what worked in the prior cycle just is not the same. And you know, I listened to something that he put out. I was listening this morning, and he said, like, I don't know what the playbook is. We're still writing the playbook for this cycle, you know, like I don't have the answers. I know that's not comfortable, but it would be, yeah, it's interesting. So the 2-year kind of gives us indication that you got to cut, but the 20 and 30 years certainly is not in any kind of agreement with that. No. I mean, that's a really steep curve.
Right. So to kind of wrap this up, as we're about at time, will you be at the NAAIM Outlook conference in Chicago in November 3rd and 4th?
Do monkeys
Jim
like
Bianco
bananas,
will be
Ryan?
there. What's that?
Yeah. I said, do monkeys like bananas?
Heck yeah, they do. And Jim Bianco's going to be there, so we can talk to him in person. He's fun. He's fun to see in person. Good guy.
Yeah, he is. Jim's a great guy. And his research, I think is great. So
it is. Absolutely.
There, you know, one of my favorite things about the conferences is there's always a ton of different viewpoints.
Yep.
I like Outlook in particularly, actually more than Uncommon Knowledge.
I do too.
Because it's a little bit smaller of a conference, and it's everyone coming with their opinions of like, here's what I'm seeing, and here's where I'm seeing it go through the lens that I view the world.
Yep.
And it's a diverse enough group. We get diverse enough speakers that you kind of get exposure to a lot of different things, and it's a great learning opportunity. Yeah. So I really enjoyed every year. It's one of my favorite things I do every year. So.
Oh no, same. I love it too. Well, I will see you there in person in a couple months from now. That'll be fun. And yeah, I guess we're good for today. Thank you for being on, Branden, stepping in last minute. I know it was kind of an interesting last minute for both of us to jump in today, but thanks for being here. Appreciate it. Good to see you.
You betcha. Take